There's a category of financial loss that does not come from bad investments, overspending on things you enjoy, or major financial emergencies. It comes from small, recurring charges that most people pay without realizing it, or without realizing how much they add up to over time. These are fees. They are built into the structure of financial products and services. They bill automatically, and because each individual charge is small relative to the total transactions in your account, they rarely trigger enough attention to be examined or eliminated. Banks alone collect tens of billions of dollars in fee revenue from retail customers every year in the United States. That money does not disappear. It transfers from people who do not understand the fee structures of their financial accounts to the institutions that design those structures to generate revenue. This video identifies the most common fees you are likely to encounter, explains exactly how each one works, and give you the specific steps to avoid or eliminate each of them. Overdraft fees are among the most expensive and most avoidable fees in consumer banking. An overdraft fee is charged when a transaction is processed against your checking account and your available balance is insufficient to cover it. The bank covers the transaction on your behalf and charges you a fee for doing so, typically between $25 and $35 per occurrence. Some banks charge this fee multiple times per day if multiple transactions overdraw your account in the same day, which means a series of small purchases on a day when your balance is low can result in a fee total that far exceeds the value of the transactions themselves. A $3 coffee that overdrafts your account by $1 costs you $38 once the fee is added. The critical thing to understand about overdraft fees is that they are largely optional. Federal regulations require that banks obtain your explicit consent, known as opting in, before enrolling you in overdraft coverage for debit card transactions and ATM withdrawals. If you have not opted in, those transactions will simply be declined when your balance is insufficient, which is inconvenient but free. Many people are enrolled in overdraft coverage because they opted in without fully understanding the fee structure, or because they were enrolled by default on older accounts before regulations tightened. Checking your overdraft settings with your bank and opting out if you are currently enrolled is one of the simplest fee reduction steps available. If your transaction is declined because your balance is low, that is a signal to fund your account, not a problem that warrants paying $35 to avoid. For situations where you genuinely want a safety net rather than a hard decline, the alternative to standard overdraft coverage is overdraft protection linked to a savings account or line of credit. When your checking balance is insufficient, funds are automatically transferred from the linked account to cover the transaction. The fee for this type of transfer, when one exists, is typically between $0 and $10, which is substantially cheaper than a standard overdraft fee. Setting up this linkage is a direct replacement for standard overdraft coverage that preserves the safety net while dramatically reducing the cost. Monthly maintenance fees are a fixed cost that many checking accounts charge simply for holding the account open. These fees typically range from $5 to $15 per month, and they apply whether you use the account actively or not. However, most accounts that charge monthly maintenance fees also offer clear conditions under which the fee is waived. Common waiver conditions include maintaining a minimum average daily balance, typically between $1,000 and $1,500, receiving a qualifying direct deposit each month, usually above a specified amount, or making a minimum number of debit card purchases per statement period. If you consistently meet one of these conditions, the fee does not apply. The problem is that many account holders do not know these waiver conditions exist, do not track whether they're meeting them, and pay the fee every month out of inertia. If your current checking account charges a monthly fee and you do not consistently meet the waiver conditions, the simplest solution is to switch to a fee-free account. Many banks, particularly online banks and credit unions, offer checking accounts with no monthly maintenance fee and no minimum balance requirement. The account works identically to a fee-bearing account. You're simply not paying a recurring cost to hold it. Switching accounts is a one-time administrative effort that eliminates a recurring charge permanently, which makes it one of the highest return actions available in personal finance on a time-invested basis. ATM fees are another category that accumulates quietly. When you withdraw cash from an ATM that is outside your bank's network, you're typically charged two separate fees. The ATM operator charges a fee, usually between $2 and $3 for using their machine. Your own bank then charges an out-of-network ATM fee on top of that, typically between $2 and $5. A single out-of-network withdrawal can therefore cost you $4 to $8 in combined fees, which is a significant percentage cost on a small cash withdrawal. Over the course of a year, even 2 or 3 out-of-network ATM withdrawals per month can represent over $100 in fees paid for the convenience of accessing your own money. The most direct solution is to use only ATMs within your bank's network, which are typically fee-free. Most banks publish a tool on their website or app that lets you find nearby in-network ATMs. An alternative is to use your debit card for purchases at grocery stores or pharmacies and request cash back at the register. Cashback through point-of-sale transactions is typically free and does not involve an ATM. For people who regularly need cash in locations without convenient in-network ATMs, choosing a bank that reimburses ATM fees is worth considering. Several online banks reimburse all ATM fees up to a monthly limit, which makes any ATM effectively free. Minimum balance fees are similar to monthly maintenance fees, but triggered specifically by a balance falling below a required threshold rather than by a fixed monthly charge. Some accounts have both. If your balance drops below the minimum on even a single day in the statement period, the fee applies for that period regardless of your balance for the rest of the month. This structure catches people who maintain adequate balances most of the time, but experience a temporary dip due to a large expense or timing mismatch between income and bills. Awareness of your minimum balance requirement and monitoring your balance around bill payment dates is the most direct mitigation. A secondary solution is, again, to choose an account with no minimum balance requirement. Wire transfer fees are charged when you send money electronically to an account at a different financial institution using the bank wire system. Incoming wire fees typically range from $10 to $20. Outgoing wire fees are often higher, ranging from $25 to $50 per transfer. For most everyday money transfers between individuals, wire transfers are unnecessary. Services like Zelle, which is integrated into many bank apps at no cost, and electronic ACH transfers, which are free or very low cost at most institutions, accomplish the same result without the fee. Wire transfers are primarily justified for large, time-sensitive transactions where the immediate finality of a wire is specifically required, such as closing on a real estate purchase. Return payment fees, also called non-sufficient funds fees or NSF fees, are charged when a payment you initiated cannot be processed because your account balance was insufficient. Unlike an overdraft, where the bank covers the transaction and charges you, an NSF fee is charged when the bank declines the transaction and returns it unpaid. The fee structure is similar to an overdraft fee, typically between $25 and $35. The additional consequence is that the recipient of the payment, a landlord, a utility company, or a lender, may also charge you a return payment fee on their end, compounding the cost. In the case of a return loan or rent payment, there may be additional late payment consequences beyond the fees. Maintaining a buffer in your checking account and monitoring your balance before large scheduled payments are the most effective preventive measures. Paper statement fees are a small but unnecessary cost charged by some institutions for mailing a physical copy of your monthly account statement. These fees are typically between $1 and $3 per month, which is trivial individually but worth eliminating because it requires one action: switching to electronic statements through your bank's online portal. Virtually every bank and credit union offers free electronic statements, and enabling them typically also eliminates the paper statement fee. It is a 2-minute change that removes a recurring charge permanently. Foreign transaction fees apply when you use your debit or credit card for a purchase in a foreign currency or with a merchant whose bank is located outside the United States. These fees are typically 1 to 3% of the transaction amount and are charged by your card issuer on top of any currency conversion. For occasional international purchases, the cost may be acceptable. For people who travel internationally with any regularity, or who make frequent purchases from foreign merchants online. A card with no foreign transaction fees is worth obtaining specifically for those use cases. Many travel credit cards and online bank debit cards waive foreign transaction fees entirely. Safe deposit box fees, account inactivity fees on dormant accounts, and check ordering fees are additional categories worth knowing about, though they are less universally applicable. Inactivity fees are particularly worth monitoring because they apply to accounts you are not using and therefore not watching. A savings account or checking account that you opened, funded, and then stopped using can incur monthly inactivity fees that gradually draw down the balance. Closing accounts you are no longer using or maintaining the minimum activity required to avoid the fee prevents this from happening silently. The overarching pattern across all of these fee categories is that financial institutions design fee structures that are most costly to people who are least aware of them. The fees are disclosed in account agreements, but account agreements are long, dense documents that most people do not read carefully. The result is that the cost of banking is substantially higher for uninformed account holders than for informed ones using identical products. The gap between those two outcomes is not luck or income. It is knowledge. Understanding the fee structures attached to every financial account you hold, knowing the conditions under which fees apply, and making deliberate choices about your accounts and behavior based on that knowledge is how you ensure that your money stays with you rather than being transferred gradually and invisibly to the institutions you bank with.